Hello, everyone. Welcome to This Week in Economics with Robert Wenzel. I'm Robert Wenzel. Boy, we've got an interesting show for you this week. The question before us is, why are current soaring bond rates a dangerous flashing signal for the economy? And boy, are rates soaring. The 10-year note, for example, Treasury bill, Treasury security note, was trading in August of last year at 0.52%. That means if you were holding treasury bills at that time, you were basically getting paid about a half a percent. That same rate closed on Friday at 1.57%. That is basically a triple in the amount of money you'd be collecting if you were to buy the treasury notes now instead of in August of last year. August of last year, you would be earning roughly a half a percent. Now you buy a treasury security 10-year note, you're going to be earning 1.5%. That's a remarkable jump in a very, very short period of time. At the same time, the rate that the Federal Reserve controls most directly, the short-term rates, specifically the Fed funds rate, is basically trading in a short-term range. The Fed funds rate, the effective Fed funds rate, at the time when the 10-year note was trading at uh, 0.52, the effective Fed funds rate was 0.07, not even 1/10%. This Friday, the effective funds rate closed at 1/10%. So it's basically in the same range. It goes up and down depending upon exactly where the Fed closes it on any day, but it's basically been in that 1/10% range. Now they're doing this because they're actively in the market. They're buying short-term securities or trading it, um, even maybe occasionally selling it to keep it at that rate. But the long rate is soaring on its own. So what's causing this? Well, there's basically three things at the present time that could be causing this. First, you can have a situation where uh, there's a lot of creativity in the economy, a lot of increases in productivity. So businessmen are willing to borrow money because they know they're making something more productive and they can make a lot of profit off of it. So they want to get at the head of the line. In order to get at the head of the borrowing line, they're willing to pay a little more in interest rates than anybody else. It's unlikely we're seeing a lot of that at this time, given the uncertainty in the economy with the lockdowns and the COVID and so on and so forth. No one knows what the economy is going to look like 6 months or a year down the road, just from the lockdown COVID um, perspective. Everybody, of course, is expecting the lockdowns will end, but nobody really knows how the economy will bounce back from that, whether business people will all head back into the offices or not, how consumers will act, will they travel, will they stay in hotels, will business people stay in hotels. So there's a lot of uncertainty in that period. So there's probably not a lot of people out there in terms of entrepreneurs jumping at opportunities because they really don't know overall what's going to happen. So where's the upward pressure coming from that these bond prices are going up? Now, there's some people that think there are bond vigilantes out there that sort of, if they see the Treasury borrowing too much or the Federal Reserve pumping too much money in, that they'll react and push the interest rates up. There are no such people. There are short-term traders that will jump on trends. If the trend is up in terms of interest rates, they'll short bonds to benefit from a further increase in rates, and they'll reverse that if they think the other thing's happening on. So there are short-term traders, but there are no long-term so-called bond vigilantes. Here's what's really pushing long-term rates up. You have government borrowing. The government is in a different situation than the uh, private businessman. A businessman will look at the interest rate and say to himself, well, can I make money if I pay this interest rate? The government, on the other hand, says, I need to buy this much money. Let's see what the best rate is I can get, but I'm going to pay whatever the best rate is. And the government is borrowing a lot of money. The net new amount in the last 12 months has roughly been 4 trillion that's been borrowed by the federal government. Now, some of that is being bought by investors who already have dollars and They're just putting it into the treasury securities, but a bunch of that is also being new printed money by the Federal Reserve. And when it's new printed money, it enters the economy and pushes up prices. So that's happening. It takes a while for it to work through the economy, but the first places you start to see it are in asset prices such as the stock market, housing, things of that nature. And that's what you're seeing right now. You're seeing a boom in the housing market, in stock market, and even other assets like Bitcoin. That's where you see it first, and then it sort of trickles down into the rest of the economy. Now, the third place you can see an increase in demand for loans right now is for businesses that are already ongoing, not creative people, not people who are necessarily found a new way to make something in a more productive manner. They're just in a business and they see their prices going up. So with their prices going up, they see, hey, if I can make more of this, I can make more money. It makes sense for me to do it because the prices are higher. So they're willing to get it ahead and bid more for money that's available for borrowing. So you got the government in there that doesn't really, in a way, care about the interest rate. They're going to borrow whatever they need to. And then you've got businesses in there who see the inflation. Just to give you an example, uh, mortgages are way up right now. Okay. And that's because people who are buying houses outside of urban cores see prices going up very, very quickly. So they're willing to pay a little more to get it to front of the line in terms of borrowing so they can buy a house before prices are higher down the road. Developers now are seeing their houses being snatched up very quickly at higher prices. So they're willing to borrow at a higher rate. So they're willing to pay the higher rate. So they're putting the pressure up on prices. And you're also getting that in the stock market. In March of last year, the amount of money that was borrowed to buy stocks, margin money, was $500 billion. Now, with the last numbers, it's 750 billion. So that's an increase of 50% in the amount of borrowing done by stock market players over the last roughly 12 months. So you're seeing this in the places you would expect it at this point. Prices that are climbing, people is borrowing to and willing to pay higher prices to get ahead of anybody else that wants to borrow money. And that's where the pressure is coming. And as the inflation works its way through the economy, you're going to see more and more people that are willing to borrow money because they think for whatever product they're going to get, they might as well buy it now at a cheaper price if the interest rate is low enough. So, how can the Fed slow this down? Well, in their mind, there's only one way to do this, and that's to buy more long-term treasury notes, 10-year notes, 30-year bonds, whatever it might be. And if they buy them, that will put downward pressure on the interest rates on these securities. And basically, uh, the only way the Fed is able to do that is by increasing the amount of money in the system, which puts added pressure on the prices that are already climbing. So it's a tiger by the tail situation. They will put more money into the securities, sort of try and keep interest rates low, but the money that comes into the system creates more inflation, making it uh, more advantageous for people that are in those asset plays, the housing developers, the stock market people, commodity price people, as we're seeing more and more commodities increase in price, to borrow, to be willing to pay more in terms of interest rates for this. At the same time, Joe Biden's uh, quote unquote stimulus package is about to pass. And that's going to require another 1.9 trillion by the Treasury, which the Treasury doesn't really have. Now, some of this they're going to have to borrow from the Federal Reserve that directly through the way it's done is the securities are sold to primary dealers. These are your local regular cronies, Goldman Sachs, Morgan Stanley, people like that. And then what happens is the Federal Reserve buys from them with the handy commission by the primary dealers. So that's how that works. But in addition to that, Janet Yellen has roughly a trillion plus really in a Federal Reserve deposit account. I liken it to walking around in a casino with a casino chip in your pocket that you can go and take to the cage at any time at the casino, and the casino will give you the money for it. So Janet Yellen, as Treasury Secretary, has a Treasury chip that was issued by the Federal Reserve in sort of technical ways, and she can go to the Federal Reserve, and she has said she's going to do this to cash that chip in. And what that means is that's another way the Federal Reserve is going to pump roughly $1 trillion, trillion plus, into the economy. So that's going to put more pressure on inflation and more pressure on interest rates. So that's what we've got going. It's a tiger by the tail situation. Fed pumps money in to keep interest rates down. That pushes inflation up. Fed pumps more money in. That pushes inflation up even more. Tiger by the tail. Now, within months, I expect inflation as measured by government indexes to hit 3%. At that point, the Fed is not going to be too concerned, remarkably, because they have a target. And don't ask me about the targets. The targets don't make any sense. Why would you have an inflation target? But they have a target of 2%, and it's been trading below. So they've got some kind of justification that, well, it's an average. If it goes to 3%, we've had periods that were less, so we're going to average it out. Makes no sense. They also don't think that inflation can spike at a rapid rate, which it certainly can. Their forecasting method is really only 10-year rear view mirror stuff. That's all they do. They look at what interest rates have done in the previous 10 years, what inflation has done, and don't think it can do anything different. That's all their forecasts are if you listen to them. They have no idea, no conception of the idea that inflation can really pop here, interest rates can really pop here. I fully expect, again, within a few months, inflation to come in as measured by government indexes of around 3%. And I fully expect it to hit 5% by the end of the year. Now, when it's at 5%, the Fed is going to take notice. But for when inflation is at 5%, they would have to raise short-term rates. Remember, short-term rates are basically the Fed funds rate is at 0.1%. They would have to raise interest rates to 6 or 7%, that short-term rate, to really battle inflation. They're not going to do that. There's no way they're going to do that. They might raise it to 2%, they might raise it to 3%, but that still means they're going to have to pump a lot of money in to keep that rate from what it would normally be in the market without their intervention. So that's going to mean more money in the system, more upward pressure on prices, more upward pressure on interest rates, tiger by the tail. The only way they're going to end this is to adopt the Paul Volcker methodology of dealing with the money supply. And that means forgetting about where interest rates go in the short term and just stop the money printing. Volcker didn't stop it completely, but he slowed it down dramatically. Short-term interest rates went as high as 20% for a short-term period, but then he killed the inflation and stopped it for an extremely long period of time, any significant inflation. That's about to end. And what I see is the Fed doing the tiger by the tail situation. Now that the interest rates are starting to climb, they're gonna do more on the long-term end of the bond market, and that's just going to put more money into the system and just cause more problems. And it's not going to work. The only way it's going to work is to stop the money printing, and they don't get that right now. So what I expect is much higher interest rates, much higher inflation. We're going to have a very messy economy, and the only way out of it, after all this crazy money printing, is to stop the printing. But that's going to crash all the assets that have been going up because of the money printing. Stock market will crash, housing prices will crash, Bitcoin will crash. I consider Bitcoin just an asset that's going up because of the inflation pump. When all the regulators could crash Bitcoin on its own, but if the Fed stops printing money, there's another way that all this can stop for Bitcoin, in addition for the stock market, in addition for the housing market and any other assets that are climbing right now. It's going to be a real mess down the road, one way or the other. Inflation could continue for quite a long time, go very, very high, or someone wakes up at the Federal Reserve and stops all this, but I don't see anybody at this point. The chairman is blind to what's going on, and none of the other Fed members are objecting. They're really mouthing the same justifications for money printing that the chairman, Jay Powell, is. So I think we have a mess ahead of ourselves. And this start in the interest rate climb is the signal that we're in the phase now where this stuff really takes off. So brace yourself. Thanks for listening. I'll be back next week.